Okay, so we want to wrap up how to understand perfect competition in the short run, and then from there we have an issue we want to discuss about it in the long run. At this point, you should have already looked at the Amos Web website to talk about the firm's shutdown price, and I just want to summarize from there how we can actually find the overall market supply curve. All right, so the shutdown point. We're going to need some curves on here to find that. So let's put on here an average variable cost, an average total cost, and where are those minimum points? Let's see here. I'm going to say that's the minimum of the average variable and the average total cost. And remember, that was important, that what we have here in our marginal average relationship is that when the marginal cost curve is below the average, that means you're adding in an additional cost for that last unit that is lower than it has cost on average, and so it continues to pull the average down. And then once you hit the minimum, obviously they're equal. In the very next unit, the additional cost is higher and it begins to pull that average up. And we have that same relationship with the average total cost curve and the marginal cost curve. All right, so we have that here. And then assuming that you have already listened, or excuse me, read and understood what the Amos website was showing about the firm's shutdown price, we want to use that idea and that information to figure out what that means for the firm supply curve and then ultimately the market supply curve. Okay, so let's see. We want to talk about the shutdown point and what that means. All right, so first of all, we can imagine a price. You know, I don't have the marginal revenue drawn in here. And remember, in the perfect competitive environment, it's just something that comes to them from on high. So if we have a nice high price equals marginal revenue equals firm demand curve, it's going to cross up here. The price is greater than the average total cost. That's a profit. And that would be true as the price comes down. Imagine the market supply, market demand situation is changing, so the market price is falling. And eventually we get to this point here where the MR is just crossing MC at the minimum of the average total cost. So price would be equal to average total cost, profit is zero. That's what's happening there. But this is a short run situation. You have fixed costs. You can be in a situation where even as the price continues to fall below this minimum area here, this zero profit area here, you will continue to work. And this is what we looked at previously, and continue to produce. Even as the price falls below average total cost and you are making a loss. Here's your price if this was your marginal revenue curve. There's your average total cost. Average total cost greater than price means you're losing on that particular unit, and on average you're losing on all units. So you're still going to produce because we turn around and we look to the average variable cost. So even though I'm making a loss, the question then becomes, okay, am I losing more or less than my fixed cost? And remember, very beginning, when we talked about these curves, the distance between the average total cost curve and the average variable cost is average fixed cost. That's the only thing that the average variable cost does not have in it. It's the only thing that makes them different. And so when we are in this range where we are not covering our average total cost, but we are covering all of our average variable cost and then some of our average fixed cost, that interprets to, okay, let's say my fixed cost is $1,000. I shut down, I lose $1,000 a month. But if I'm producing in this rate region right here, my loss might be $800 or $600. So I lose less by being open. And so that's the whole idea of why you would produce as long as your price is greater than the minimum of average variable cost. The reason it's the minimum of average variable cost is as our marginal revenue curve, if it were to continue to fall, it's going to come through, you're going to produce in all those points and make a loss until you hit here. And if the price were to fall any lower, you are actually in a place where price is lower than average variable cost. You're losing more. You're not only losing your fixed cost, but by producing, you're adding to your loss. That's why you shut down. Okay, so then what we want to focus on is that from a firm's point of view, when you think about what a supply curve is, it's the answer to how many units you can produce at each price. And so the marginal revenue would come across, as we were showing, an equal marginal cost, and that determines your quantity, right? So each one of these points here was answering that question for this firm. How many are you going to produce at each price? And that would be true all the way down to here. because once you go to a price below the minimum average variable cost, any prices below that, your answer to the question is, I'm not going to produce any. I'm going to have a zero quantity. And so what we have then is the firm supply curve goes along the marginal cost, along its marginal cost curve, starting at the minimum of the average variable cost, okay? So then when you want to extrapolate that to the market supply curve, all you have to do is take every firm. You can hypothetically imagine that you could take every firm. Let's say that this minimum price over here was $3. I just invented that. So what we know then is that the market supply at $3, there will be some quantity supplied by this firm, and let's just assume all the firms are identical. All the firms will produce some quantity at $3. Add that up across the firms. If this quantity was, let's just say 100 here, then by the time you've added across all the firms, maybe it's 1,000,000 units here. So there is some supply at $3. And you would continue to add that up across all the firms, and you would get the market supply curve. But what's important is for any price below $3, the quantity being supplied is zero. They're not going to supply any. And so that's how we can use our understanding of the perfect competition market structure and its interaction in the short run with its average total cost, its average variable cost, how it decides, should I produce? If so, how much am I going to produce? Am I making a profit? Am I making a loss? It all ties together and allows us to understand where the market supply curve is actually coming from. Okay, so that wraps up an understanding of how the market price coming down to our little perfect competitor as a given price, how he then can decide, do I produce or not? Am I making a profit at price greater than average total cost? I'm making a profit. Price falls to something between average variable cost and average total cost. I'm making a loss, but I will keep making it in the short run. If it fell below average variable cost, of course, I'm out of here. But we can take that information and also see how this sort of action in the short run can extend into the long run and help us understand what will happen to the market in the long run. Basically, with the perfect competition, we have to remember our three characteristics. One of them was ease of entry. So are you going to sit there in the long run and continue to make a loss? Or will you think, maybe I should find something else to do with my time and resources? And so what does that mean for the long run in the market? So that's what we want to look at next.